Welcome to the Deep Dive. We're here to help you cut through all the noise, basically taking huge amounts of information and boiling it down into insights you can actually use. Our goal, to get you really well informed and quickly without feeling like you're drowning in numbers. Today, we're jumping into something pretty fascinating: financial statements. I know, sounds like just numbers on a page. But what if those numbers actually tell a company's whole story? Its health, where it might be struggling, the big moves it's making. That's what we're going to unlock. And we've got three key tools to help us do that: horizontal analysis, vertical analysis, and something called common size financial statements. Think of these as your secret decoder ring for figuring out what those figures really mean. They can uncover some pretty surprising things. Before we dive deeper, a quick reminder that this deep dive is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com. Whether you're an accounting student, CPA candidate, or professional, visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. Special thanks to Professor Farhat for providing this valuable material. Okay, so let's unpack this. First up, horizontal analysis. This is kind of like being a financial detective. You're looking at how the numbers change from one period to the next, usually year over year. But it's not just about spotting that a number went up or down. It's about understanding, well, how significant is that change? What does it actually imply?
Exactly. And the process itself is pretty straightforward. You compare this year's number to last year's number, that's your base year. First, you figure out the dollar difference. Then you calculate the percentage change. That percentage, that's often where the real story starts to emerge.
Yeah, and this is super useful for auditors or anyone preparing these statements. They don't, manually check every single line item change. That'd be impossible. Instead, they often set up thresholds. Like maybe they decide to investigate anything that changed by more than, say, $20,000 and also changed by more than 20% up or down. But those numbers, the 20K and 20%, they aren't set in stone. They're flexible. It depends on the company's size, its history, the industry it's in. Experience plays a big part in setting sensible thresholds. It helps focus attention where it's needed most.
Okay, let's make this real. Let's imagine a company, we'll call it Deep Dive Innovations. We're looking at their balance sheet, and we see cash and cash equivalents just shot up, maybe from $100,000 last year to almost $149,000 this year. That's a 48.8% jump. That definitely hits both those example thresholds, right? So your first reaction might be, wow, more cash, that's great. But is it always? What kind of things would make an auditor immediately look closer at a big cash increase like that? Could it be a red flag?
That's a really good point because, yeah, it's not automatically good news. A big jump in cash could mean they took on new debt or maybe issued more stock or sold off some major assets. It could also be positive. Maybe they got really good at collecting cash from their sales. For an auditor or even management, the key is tracing it back. Where did it come from? Is this a sustainable thing from operations or just a one-off event? Because, having too much cash sitting idle isn't efficient either. It might mean they're not reinvesting enough for future growth, which could hurt shareholders down the line.
Okay, that makes a lot of sense. So sticking with deep dive innovations, what about accounts receivable? Let's say that went down by $85,000. That's a big dollar amount, but percentage-wise, maybe it's only like 16.7%. Now, if their sales were actually strong or even increasing, this looks interesting, doesn't it? Sales up, but the money owed by customers is down. That sounds like they're collecting their cash way faster.
Exactly. That's a strong signal. It suggests better efficiency in managing their working capital, which is usually a very positive sign for their liquidity.
Okay. Then maybe we see trading securities. Let's say for deep dive innovations, the value dropped 11%. So did the investments just perform badly? Or did they sell some off for strategic reasons? You'd want to know why. And inventory. What if that suddenly jumped up 14%? If Deep Dive Innovations is, say, a retailer, you immediately start asking questions. Are they stocking up because they expect a huge sales season? Or is it because sales are slowing down and now they're stuck with stuff that might become obsolete? That could mean write-downs later.
Oh yeah, that inventory point is crucial. If inventory grows much faster than sales, that is a classic warning sign. Could be obsolescence, like you said, or just inefficient use of capital tied up in stock. For a tech company, maybe it's old components. For retail, maybe last season's clothes that didn't move. Either way, it locks up cash.
Right. And then there's the big one: property, plant, and equipment, PP&E. Let's say Deep Dive Innovations shows a 10% increase here. Okay, probably bought some new stuff. But here's where we connect the dots. If you flip to the income statement and see depreciation expenses up, not 10%, but like a whopping 150%.
Whoa.
Yeah, that immediately makes you stop. Did they buy a ton of new assets? Or did they maybe change how they calculate depreciation? That could really swing reported profits.
Absolutely, you have to investigate that discrepancy.
Even looking at liabilities for deep dive innovations tells part of the story. Maybe notes payable went down, they paid off some loans. Good. But maybe accrued liabilities went up, things like unpaid wages or utilities. So seeing how those pieces move together helps explain where the cash went or came from. It's all interconnected.
Definitely. Now let's shift over to Deep Dive Innovations' income statement. Horizontal analysis is just as powerful here. You look at sales, maybe they're up 10.9%. Then you look at cost of goods sold, maybe it's up 10.8%. Okay, pretty much in sync, that's usually normal. But what if COGS was suddenly climbing faster than sales? Say Deep Dive Innovations relies heavily on oil and energy prices spiked. Their raw material costs shoot up. If COGS rises disproportionately, that could signal serious pressure on their profit margins. Needs immediate attention. And here's one that often raises eyebrows: research and development, R&D. What if, for Deep Dive Innovations, R&D spending is down an alarming 20%? Now, if this is a tech company or maybe a pharmaceutical firm, industries built on innovation, you absolutely have to ask, why the deep cut in R&D? It might boost profits this year, sure, but it could seriously cripple their future growth, their competitive edge down the road.
That's a great point about the short-term profit boost. But could a cut in R&D sometimes be strategic? Like maybe Deep Dive Innovations is shifting from inventing new stuff to just making their current products better or cheaper.
Yeah.
How would you tell the difference just from the numbers?
Well, you'd look for other clues. Are they suddenly spending a lot more on marketing existing products? Did they announce a change in strategy? That R&D cut itself is just a flag. You need that context. Look for other signals that support one story or the other. And finally, net income for Deep Dive Innovations. Let's say it's up 16.6%, but sales only grew 10.9%. Why is profit growing so much faster than revenue? That brings us right back to the R&D question, potentially. Could those R&D cuts be why net income looks better in the short term? It's a very common trade-off managers make.
And practically speaking, for folks doing this analysis day to day, a lot of software now has tools like conditional formatting and spreadsheets. It can automatically flag these big swings for you, turns a wall of numbers into something more visual, showing you exactly where to start digging. Okay, let's switch gears now. We've looked across time with horizontal analysis. Now let's look within a single period using vertical analysis. This helps us understand the makeup or the composition of a financial statement. We basically turn every single line item into a percentage of some key base figure on that same statement. This technique is often called creating common-size financial statements.
Exactly right. And the base figure is standard. For the balance sheet, the base is always total assets. We just set total assets to equal 100%. Then every other asset, every liability, every equity account is shown as its percentage of those total assets. On the income statement, the base is total sales or revenue. That becomes 100%. And everything else, COGS, operating expenses, net income, is shown as a percentage of sales. This is fantastic for seeing internal shifts, but also, crucially, for comparing your company to others in the same industry.
Okay, let's try this with Deep Dive Innovations balance sheet again. Remember that cash jump? Let's say cash went from being 1.45% of total assets last year to 2.6% this year. So vertically, we see that a larger slice of the company's total resources is now sitting in cash. It's not just more cash in dollars, it's relatively more important compared to everything else they own. That signals a shift. And accounts receivable. We said it went down in dollars. Maybe vertically it went from 17% of total assets down to 14%. This just reinforces what we saw earlier, right? It confirms, from a different angle, that they're managing receivables better relative to their overall asset base. A nice double check.
Exactly. That confirmation is powerful.
Now, PP&E. For lots of companies, this can be huge, like maybe 75% to 78% of total assets if they're in manufacturing or something capital intensive. If Deep Dive Innovations consistently shows PP&E around, say, 67% of assets, you instantly know, okay, this is an asset-heavy business, big number, needs scrutiny. But interestingly, even though it's large, PP&E is often tangible, well-documented, maybe a bit easier to verify in an audit compared to something like goodwill.
That's a fair point.
And then you have small accounts, like prepaid expenses. Vertically, they're usually a tiny sliver, maybe less than 1%, confirms they don't have a huge impact on the overall picture for most companies.
Right. Now let's flip to Deep Dive Innovations' income statement, common sized against sales. Sales equals 100%. Cost of goods sold as a percentage of sales. Maybe last year it was 55.29%, and this year it's 55.56%. Pretty stable. That tells you their direct costs are scaling nicely with revenue. Their gross margin per dollar of sales is holding steady. That's generally healthy. But let's revisit R&D as a percentage of sales. Remember, it dropped 20% in dollar terms. Vertically, maybe it went from being 10% of every sales dollar down to just 7.8%.
Wow, okay. So seeing it as a percentage of sales makes that horizontal drop seem even more significant, doesn't it?
It really does. It's not just fewer dollars, it's a deliberate reduction in how much they're reinvesting in innovation relative to their size, measured by sales. That gives critical context about their strategy and future outlook. And finally, maybe their net profit margin, net income as a percentage of sales is pretty stable too. Perhaps 16.7% last year, 17.73% this year. This number tells you, bottom line, how much profit they squeeze out of every dollar of revenue after all costs are paid. It's a key measure of overall efficiency.
Now, we've mostly talked about comparing just 2 years, but the real power, the real insights, often come when you look at data over several years, right? That gets us into trend analysis.
Absolutely. 2 years gives you a snapshot, a comparison. But looking at data for deep dive innovations over, say, 5 or 10 years, that reveals the deeper patterns, the long-term efficiencies, or maybe inefficiencies, and strategic shifts. For instance, you'd hope to see sales and cost of goods sold generally moving up together over time. But a company that's becoming more efficient might show its COGS growing just a bit slower than its sales over that decade. That widening gap between the sales line and the COGS line on a graph, that's showing you improved operational efficiency. Maybe they got better at sourcing or achieved economies of scale.
And it's amazing how much impact tiny percentage changes can have, especially for huge companies. Think about a Walmart or an Amazon. If they improve their gross profit percentage by just 1%, that can mean hundreds of millions, maybe even billions, in extra profit. Plus, these common size percentages are perfect for comparing deep dive innovations against its competitors. Are they doing better or worse than the industry average on key metrics? That context is invaluable.
So, bringing it all together, these tools, horizontal, vertical, trend analysis, they're not just academic exercises. They're absolutely fundamental for so many people. Investors use them constantly to decide, where to put their money. Creditors rely on them heavily to gauge risk before lending potentially huge sums. Auditors use them to focus their testing and ensure the numbers are fair. And of course, management themselves use these analyses to make critical strategic choices about where to steer the company. It's really the language of business performance.
So I guess the real takeaway here for you, the listener, isn't just about finding the numbers that changed or calculating the percentages. The goal is always to ask why. Keep asking why. It's about connecting these different pieces, a change here, a percentage there, across the different statements to build a full picture, a real story about the company's financial health and direction. It's about turning that raw data into genuine understanding. And just like that, hopefully this deep dive has armed you with some really effective ways to look at financial statements. You're not just staring at numbers anymore, you're starting to see the stories they tell. You're becoming a bit of a financial detective yourself.
So here's something to think about. If someone handed you a company's financial statements right now, based on what we've discussed, what's the one relationship or trend you'd want to investigate first? And what's the main question